Behavioral psychology highlights how cognitive biases and emotions influence financial choices, often leading to irrational investment decisions. Here are 10 ways behavioral psychology impacts your investment habits and tips on how to navigate them effectively. 1. Loss aversion. Loss aversion refers to the tendency to fear losses more intensely than the joy of equivalent gains. This bias can lead to overly cautious investing or selling assets too soon after minor dips. To combat this, focus on your long-term goals and consider the bigger picture rather than short-term fluctuations. 2. Overconfidence bias. Overconfidence leads investors to believe they can predict market movements better than they actually can. This often results in taking unnecessary risks or making frequent trades. Regularly review your portfolio with humility and seek diverse opinions to balance this bias. 3. Herd mentality. Following the crowd may feel safe but can result in buying high and selling low. Investors often buy overvalued stocks during a boom or sell during a downturn to avoid feeling out of step. To mitigate this, stick to your investment strategy, and remember that trends don't guarantee performance. 4. Anchoring bias. Anchoring occurs when you fixate on a specific price or value, such as the original purchase price of a stock. This can cloud judgment when considering selling, leading to emotional decisions. Instead, periodically reassess your investments based on current performance and future potential. 5. Confirmation bias. Seeking information that confirms pre-existing beliefs can reinforce poor financial habits or hinder flexibility in adjusting to new market conditions. Avoid this bias by reviewing a range of perspectives, including ones that challenge your current strategy. 6. Recency bias. This bias makes people overly influenced by recent events, leading them to believe recent trends will continue indefinitely. In volatile markets, recency bias can lead to reactive decisions. Combat this by considering historical data and consulting financial indicators that span broader timelines. 7. Endowment effect. The endowment effect occurs when people place a higher value on assets they own than on identical assets they don't own. This may lead investors to hold on to poor-performing stocks, unwilling to sell at a loss. To counter this, review investments objectively and consider reallocating based on potential, not attachment. 8. Mental accounting. Mental accounting is the habit of treating money differently depending on its source or intended use. For instance, you may invest a tax refund recklessly as extra money. Practice viewing all investments as part of your overall portfolio rather than isolating funds into categories. 9. Fear of missing out, FOMO. FOMO can lead to jumping into overvalued markets due to the desire to not miss out on high returns. This often results in buying late and risking losses. Remember that there are always investment opportunities, and missing one doesn't mean you're losing out on potential gains. 10. Status quo bias. This bias encourages investors to avoid change, keeping a portfolio stagnant and potentially missing out on better opportunities. To avoid this, review your investment strategy annually to ensure it aligns with current goals, market conditions, and your risk tolerance. Understanding these psychological biases helps you make more balanced, rational investment choices and recognize when emotions are influencing your decisions. By managing these biases, you can work toward a more disciplined approach to building wealth and achieving financial goals.